Imagine comparing two companies' financial reports. One shows profit one way, another uses a different approach. Confusing, right? The International Accounting Standards Board, or IASB, saw this problem and introduced IFRS 18. This new standard doesn't change what numbers are reported, but how they're presented, especially in the statement of profit or loss. Previously, companies could group income and expenses however they liked, making comparisons tricky. IFRS 18 enforces a uniform structure, so financial statements are easier to read and compare. Think of it as organizing a messy closet. Now, every item has its place. The goal? Clearer communication and greater trust in financial reporting worldwide. The standard takes effect for annual periods starting January 2027, but companies are already preparing. For investors and students, understanding IFRS 18 now is a smart move. It's a major step forward in financial reporting. This script will explain what IFRS 18 is, why it matters, and how it will impact the financial world. Get ready for a simpler, more transparent way to read company performance. Let's dive in. Scene 2, a quest for clarity. The journey to IFRS 18 began with a key question. Are financial statements as useful as they could be? Investors and analysts complained that vague presentation rules made it hard to compare companies, even in the same industry. Companies often used their own profit measures, like underlying profit, with no standard definition. This led to apples to oranges comparisons and undermined confidence. The old standard, IAS 1, only required revenue and a final profit figure, no clear subtotals in between. Companies could highlight flattering numbers and hide recurring costs. The IASB launched the Primary Financial Statements Project to fix this, aiming for clarity and comparability. IFRS 18 is the result, a standard designed to make financial statements more transparent and useful. Scene 3. Structuring the statement of profit or loss. 18's biggest change is a new mandatory structure for the statement of profit or loss. All income and expenses must now fit into 5 categories: operating, investing, financing, income taxes, and discontinued operations. This structure is required for all companies using IFRS. The operating category covers core business activities, revenue, costs, and admin expenses. Investing and financing categories are shown separately, clarifying how investments and borrowing affect results. IFRS 18 also mandates 3 profit subtotals: operating profit, profit before financing and tax, and total profit for the period. These clear stopping points make it easy to compare companies at each level. The result? A logical, transparent income statement that highlights true business performance. Scene 4. A practical comparison. Let's see IFRS 18 in action. Under old rules, a company's income statement could mix operating, investing, and financing items, making analysis confusing. For example, finance costs might appear next to selling expenses, and one-time gains could be buried in other income. Investors had to dig to find out how the core business was really doing. With IFRS 18, everything is organized. Operating profit is clearly shown, with investing and financing results separated below. Gains from selling assets go in investing, interest expenses in financing. This strict separation makes financial statements much more transparent. Now, investors can quickly see operational results, then how investments and financing affect the bottom line. Comparing companies is finally straightforward. IFRS 18 turns a confusing list of numbers into a clear story about performance. Scene 5. Decoding the new language of IFRS 18. IFRS 18 introduces new terms and rules for clarity. The most important is operating profit, a strictly defined subtotal showing profit from main business activities. Another key concept: management-defined performance measures, or MPMs. Companies can still use custom measures like adjusted EBITDA, but now must explain and reconcile them in a single note. This ensures transparency. Investors see exactly how these numbers are calculated. IFRS 18 also gives clearer rules for grouping and separating items. Unusual or large expenses must be shown separately so nothing gets hidden in broad categories. The result: investors get a more accurate, honest view of company performance. Scene 6. A brief history. The road to IFRS 18 was long. After the 2008 financial crisis, investors demanded more transparency and comparability. The IASB launched the Primary Financial Statements Project in 2014, gathering feedback from around the world. A discussion paper in 2019 and an exposure draft in 2020 drew hundreds of comments. The final standard was issued in April 2024, effective January 2027. This careful, inclusive process ensured IFRS 18 addresses real-world needs. It's a global solution to a global problem in financial reporting. Scene 7. Navigating the future of financial statements. IFRS 18 is a game-changer for financial reporting. For investors, it means less time decoding statements and more reliable comparisons. For companies, it's a chance to improve internal analysis and communication, not just a compliance task. Early preparation is key. Companies should start mapping their income and expenses to the new categories now. Regulators and auditors will benefit from the clarity and consistency, making reviews easier. The new rules for management-defined measures will reduce misleading reporting and boost accountability. In short, IFRS 18 brings more transparency, comparability, and trust to financial markets. While the transition may be challenging, the long-term benefits are clear. Investors get better information, companies get a clearer framework, and markets become more efficient. As 2027 approaches, everyone should embrace this step toward a more understandable and trustworthy future for global accounting. Thanks for watching. Now you're ready for the new era of financial reporting. End. Fade out.